Hello, welcome everybody. Thanks for joining us today. We are broadcasting live from somewhere in the wilderness where I am, and I'm not going to tell you where it is. And Glenn is in Ontario. Thank you for joining today. Super happy to have you. We're going to be talking about a project that is live, largely funded in a significant way, and you'll get the background in a minute, but you'll see that Starlight is based in Canada, has a lot of rental properties. It's like a ridiculous amount. I think it's 50,000, maybe it's even 70. The It reminds me of the the big rental landlord in New York City. Um, and you guys far exceed that, which was always impressive. Um, so they focus on owning the rental market. They've done a lot of development to own that in Canada, and they're also branching out, which is the purpose of this pitch today and really discussion. Make no mistake about it, we are doing this to raise money, and you'll see what's going on here. Um, uh, but the development in the UK for rental housing as well. So super interesting, lots of legacy history and skill set here. Lots of people involved to execute on that, and we'll be talking in depth about that. But again, thank you for joining us today. If there's anybody that you think would be interested in hearing what you hear, we're going to be posting it on the Family Office Insights YouTube channel, I think, as long as we get permission from Glenn. And otherwise, you can get it privately. And you're welcome to connect directly with Glenn to discuss potential deployment of capital into this project. And for the record, if there's something you want funded, you can talk to Glenn about that, but after this is funded, so don't barrage him with looking for for him to fund your projects, just to be super clear, because he's hyper focused on getting this one done. Just wanted to share that with you. So with that, Glenn, thanks for doing this. We have had a couple of really good discussions. Looking forward to this one. Start with a little background on you and then the founder of the company. I mean, you guys are institutional quality, like beyond. So please share it with us to start.
Thank you. Thank you, Arthur. And good afternoon, everybody from Toronto, Canada. We are
Did I say
still,
Ontario?
you
Did I
said
say?
Ontario. That's okay.
Yeah,
Toronto is in Ontario. You
yeah,
were
yeah.
100% correct. And we're still a sovereign nation. We're not your president's
Yeah, right.
51st
It's
state. I've used
fun to
that with
talk about, though, isn't it?
it is. I had to throw it in there. I always
Yeah.
throw it in on these type of calls. But I'm really delighted to be here and to be with you, Arthur, and your partners on the line. Let me give you a little bit about my background. I can talk about Daniel Drimmer, who's the founder of Starlight, talk a little bit about our milestones, and then jump right into this exciting opportunity because that's what it is. And it's an opportunity. It's what I'll call an institutional opportunity. It's a vintage opportunity to invest in what's called the build to rent sector in the United Kingdom. And the way we've structured it for this group on the line is very attractive. But let's go back to who I am. So my name is Glen Hirsh. I am the Chief Operating Officer of Starlight Investments. I've been here coming up to about 8 years. And my background is originally from Montreal, Quebec. I'm a chartered accountant by profession. Spent a large portion of my life in investment banking, 16 years at two of Canada's large Charter One banks. And then I moved over to the principal side, and I was at a very large Canadian pension fund for a little while. And then I met Daniel once again because I had known him from my days as a banker, and this business was growing quite rapidly. And he invited me over to be his chief operating officer. So that's my journey to being in this role. At Starlight, I oversee both our strategy and operations group, our information technology, our sustainability practice, our internal audit and compliance, and our people and culture group. So I have a pretty big mandate here. Daniel is interesting. We just celebrated a milestone, 30 years in business in Canada. And Daniel is originally from Europe. His family originated from Berlin, and he moved here in the mid 90s because the family had some initial allocation in Canada. as part of a diversification strategy outside of Europe, particularly in Germany. And he came over here in the 90s, and got to know the market much better, and then built up that business. Family just celebrated roughly 75 or 77 years in the real estate business in Europe. So long line of real estate stewards of capital, owners, operators, and investors. It's interesting. I'll just tell you something anecdotally before I jump into Starlight. When I joined here in 2017, I did my first town hall, and I remember we were about 100 people, and I was saying, it's so amazing. We've got these great growth targets. We were sitting at 7 billion of assets under management. And this December, I did my town hall to the organization. We're now 400 people, and we crossed 30 billion of assets under management. So that's a big milestone for us.
Crazy.
Amazing growth when you think about it. So I mentioned some milestones. So number one would be we're celebrating 30 years in business. Arthur stole some thunder of mine in terms of our scale. In Canada, we own roughly 55,000 units, suites. So we're the largest property owner in Canada in the apartment space. In the US, we have a portfolio of about 11,000 suites, primarily in the Sun Belt and some in the mountain region. In our commercial side, we have 7 million square feet of business. 7 million square feet of space. And that is primarily an office portfolio. And then a really exciting part of our business, which we initially went there about 6 years ago, but launched it in earnest after doing several years of due diligence, was our UK business. And I'm going to get into that in a moment. I want to talk a little bit about Starlight, but that's really where the opportunity is. We've structured the built to rent business. We've got about just under 4,000 units that were in development in the UK. We're not in London, and I'm going to talk a little bit about the strategy and the theory behind that, why we're in the major regional centers and the London commuter belt, and not primarily London. Why is that? Number one, we want to own product that is attainable and affordable to renters, basically. And what we're seeing in those markets is, they're roughly 30% less, 40% less than what rent would be in central London. And more than that is the defensive nature of the asset by acquiring it at 50% of the value what you would see in London. So when you're seeing 10% IRRs in central London, we're experiencing 18 to 22% IRRs.
Room for growth, right?
Room for growth. So as a matter of fact, what I'm talking to you today will be our second fund in the UK. Our first fund in the UK, which we raised 230 million pounds, we've got about 1,800 units in our first fund. That latest tracking came in at around 24.9% IRR. We're developing about 1,800 units. These are cities like Liverpool, Manchester, Ashford, Leeds, places like that. So the other thing I wanted to mention about our team, so I talked about how we're 400 people at Starlight. One of the things that should give you comfort is that we have a lot of continuity in our senior executive complement, and particularly in our staff as well. You don't tend to have a lot of turnover in an organization. So, we're able to provide the diversification in terms of the work streams, and to be able to attract, retain, and develop what we'll call best in class. Last point before I move on is, as part of this global nature of our business. So I talked about our Canadian business. I'm going to talk to you a little bit more about our UK business, and a new venture which we're going to be launching in the next little while is Spain. So we're now heading out to Spain to replicate the success that we're seeing in the UK. But today our discussion is on the UK. Our head office is in Toronto, where we're roughly 375 people. And then we've got another 25, 30 people in our offices in the western part of Canada, in the province of British Columbia, in Vancouver, and in the Vancouver Island called Victoria. So that's where we are. I talked to you a little bit about sort of our different streams. We have our Canadian business, our US business, and our UK business. So what I thought I would do is talk to you a little bit about why is it the opportune time to be investing in the UK? And this is what we're talking about. So I don't know if many of you are familiar with the UK market, but it's a very nascent market. They don't have a rental market per se. And in a country of 69 million people, if I throw out a number to you like 115,000 purpose-built rental units, that would be shocking to you. Canada, which has 40 million people, we've got around 2.5 million units of rental units. That's our inventory in Canada. That's comprised of purpose-built rental of about 1.9 million units. And then the balance, 300, 400,000, is the shadow condo market. These are what they call the private rental sector. It's really one-offs. There's no amenities. It's not institutional. It's mom and pop. So that's the number one. The reason why this is an opportune time is we're seeing the same factors that we see in Canada in terms of strong immigration, inability to afford a home, the high cost of home ownership is bringing people to rent. What we're seeing in the UK is that they're running about a million unit deficit. I think the actual number is 800,000 or 900,000 deficit of units to satisfy the demand. So that dislocation is current and it's growing. We're seeing it in Canada as well. So we're very used to it in Canada, this dislocation between the supply of rental stock and the demand that's being put on that stock. That's the housing crisis that everybody hears about. So we sat back and we said, okay, there's a real opportunity in the UK. Which markets do we want to actually go and mine? So we said London's too expensive. The renters can't afford it, and we're not seeing strong rental growth in that market. As you know, it's either flat or slightly above. It's single digits, low single digits. So we said, let's look at major regional markets and the London commuter belt. And I'm going to get into that in a moment. But basically, it's around the dynamics of growth and affordability. So what is our strategy? I want everyone on the call to think about it's a risk mitigation strategy. We're in the risk mitigation business. Okay. Yeah. So how do we do that? Well, the first thing is we do a forward purchase strategy. So two things that gives you as potential investors and how we found success with our existing investor base. Number one, the forward purchase strategy puts all the risk of completion, all the risk of cost escalation on the developer. Let me just repeat that. The risk is on the developer. And I'm going to tell you why they take that on with us. So that's number one. Number two is we're mitigating the risk because throughout the development process, the cost escalation, by the time we complete the project and it gets delivered to us, we're getting it at a discount to replacement cost by that point because we're locking in cost today. If I had to quantify for the folks on the phone, it's working out to about 150 to 200 basis point discount in cap rates to stabilize cap rate. So if I'm buying it at call it a 6 on a forward purchase basis, that stabilized asset would be a 4.3, 4.4, 4.5 cap rate.
Yeah.
That's what we're experiencing. But I also want to give your listeners something else to think about. One of the things that we're doing in this second fund number 2 in the UK, is we are warehousing a seed portfolio. So we've already stored on our balance sheet 3 assets. It's 1,541 units that we own already. We've owned for about 6 months. We're going to vend those in at cost at closing. So you're going to own it.
Still need to be developed though, correct?
There's still everything. This is a development play. So they're either in construction or shovel ready.
Yeah.
There is no waiting for permits or zoning. Everything is permitted. We are fully entitled.
Yeah.
So it's either already in construction or shovel ready. They will all vend in at the initial cost. Now, I told Arthur before the call, at March 31st, we had them reappraised, the 3 assets. They have a cost base of around 507 million pounds. And we've got about a $20 million, $22 million uplift already in the reappraisal. That's on your account. You're already in the money when you come in. The last thing I want to tell you is in terms of the flow of your capital, it's a very steep J curve because all we're required to do in our contract is put down between 7.5% and 10% of the equity. So we do a deposit of 10%. We don't call the capital from you until basically year 3 and 4. So there may be some capital called between years 1 and 3, just as more deals come on and we start finishing up the construction, or we take on more deals. But really, it's year 4, right before substantial completion, where we call the capital.
And you have to
So
you're calling the capital to do the final close.
to do the final close,
Once the project's done, right?
all you've put out is your 7.5 to 10% deposit.
Yeah.
That's it. And all you'll pay fees on are that called capital.
Call capital. Yeah.
Yeah, we're not gonna
Yeah.
we don't, there's no fees on commitments.
Yeah.
Okay. So that's really the strategy. Let me talk a little bit about the offering, and then I'll get into some of the specific. So on this particular fund, Fund II, we are looking to raise between 400 million pounds and 500 million pounds with a hard cap of 600 million pounds. Okay. We're targeting an IRR of 18 to 20% in a 5-year closed-end fund. Okay. The way we're accommodating this particular group, and we created a sleeve for what I'll call the family office high net worth channel, which is exactly this, is that this feeder is not bound by the same requirements as our large institutional investors. So for example, in our large institutional, so on this particular fund, we've raised roughly 246 million pounds already, all institutional. Minimum tickets were around 20 million pounds. The average tickets are around 30 to 40 million pounds. This is not that. There is no minimum on this close to that. You're talking £500,000 to £1 million is your minimum. Okay. That's in pounds. So you're able to get institutional access shoulder to shoulder with global institutions that have come in at $40 million tickets for £1 million, let's say. The other thing we're going to be providing on this is the seed portfolio being rolled in at cost. So you're already in the money on that, and it's not a blind pool because we've allocated half of the equity already. Half of the target equity is sitting in a seed portfolio, 3 assets, 1,541 units. 2 are in Manchester, and 1 is in Basildon, which is in the London commuter belt. And I'll show you pictures of those assets.
Did you have to close on that project with?
Yeah.
Yeah. So the committed capital, like if in your family office sleeve, if I said, okay, I want to give you $2 million, you've already closed on that seed portfolio. So you're still only going to call $200,000 from me, and I get the 10% bump on the seed capital.
Yeah. That's how these forward purchases work.
Yeah.
Okay. So, and for those on the call, in Canada, we've done about 5.4 billion of forward purchases. We're very experienced in forward purchases, but I want to tell you why. We're very experienced in forward purchases because we have a 40-person development team here at Starlight. We're also a developer. So I talked about our business and our rental product that we own, but we also have a pipeline of 28,000 units. I've got 1,800 units in development at the moment. I've got 40 people on my development team all across Canada in various phases of development. So, just so you know, for everybody on the call, each of these projects have step-in rights. If for some reason we made a bad call on the developer and we have to step in. So, but we're using best-in-class home builders, best-in-class what you'll use in your vernacular, the condo builders, but it's called PRS or built to sell, right? We're engaging you in build to rent. I want to just add one more point. The other point that I want to add is why, and I'm going to talk about some of the institutions that are now coming into the UK BTR market. What makes us unique is because we've done so much forward purchase, we're involved with the developer throughout the piece, through the design.
Yeah.
So we know how to design rental product better than anybody because we own 55,000 units here and we're developing 2,000 units a year. So we are the most what I'll say knowledgeable in terms of how to design a scheme to suit a renter in terms of amenity space, the fitness, where to place refuse, where to place the garbage chutes, how to design the foyers, how to ensure that we're compliant with sustainability and ESG. Everyone talks about ESG until everyone looks at your carbon footprint and they want to ensure that you're on the net zero plan. We're fully compliant. We're actually a GRES participant. We've ranked first in our GRES category for 2 years in a row. So we are fully compliant on that. And all of that gets embedded into this design and scheme of each of these built to rent units. I just want to give you a sense of the market effectively. And I want to explain to you why built to rent is an opportunity. So surely when I tell you that there's only 115,000 rental units, it's true, because 98% of the private renters are renting from mom and pop owners. These are what they'll call the private rental space, the PRS. Now you can only imagine in these units, there's no amenity, there's no landlord you're calling if your toilet backs up. It's basically what we'll say is it's as if someone you go out and you buy a couple of units and you find tenants.
Yeah.
That's what that is. Now, the issue with that is that they're mom and pop. So what we discovered in our research is that 93% of the UK landlords own fewer than 10 units. They own fewer than 10 units. It is non-institutional. It is non-institutional. Now, from that developer, from the condo developer, if you will, they're locked in there. They've got to do their pre-sales. They have to get their construction financing. They're on the hook. You can have defaults. You have those that don't close. You can't recycle cash. We come in and we're providing price certainty and closing certainty. It allows them to recycle, and they don't have to sell one by one. Okay?
Makes a lot of sense. And you can't arguably, I'm going to suggest I know what you found out. So if I'm wrong, please tell me. You found out that it's not a plausible strategy to go roll up the mom and pops, because they'd have the same problem. You'd have the same problem as they've got 10 units scattered all over the place with no central method of taking care of it and creating consistent, service levels, right?
That's issue number one. The other thing is, we know how effective an institutional-like rental product can be, because we're the largest in Canada with 55,000 units. We have 11,000 in the US. We understand the upside of delivering quality institutional product to residents. We just do. We know that business. I mean, I've got 284 people in my firm just on asset management in Canada. We're the largest asset manager. So we know how to deliver a product and grow NOI and create return, but at the same time, delivering a quality product to a resident and to a renter. The other thing that you'll find is, and you were alluding to this, is that, let's call it, of the 28 million households, let's say in the UK, of which 20% are renter households. So call it 5.5 million. The UK, what we'll call the Landlord Tenant Board, just deemed 20% of those, so 1 million units within that PRS, have been deemed unlivable. But you're not surprised. You've seen that in markets where the landlord doesn't reinvest. That's not us.
Mm-hmm.
So what we discovered in our due diligence is that this looks a lot like Canada 20 years ago. That's the opportunity. This is the opportunity.
And is Brookfield or Blackstone or any of the big boys, have they taken note of this as well, or is it just not really interesting to them?
So it's interesting. So in 2024, there was $8 billion of equity that flowed into the UK residential market, in the BTR market. Okay. And it's the likes of BlackRock, Oxford, CPP, PSP, Greystar, Blackstone, Aimco, NFU Mutual, Aware. They're all there. But none of them are doing forward purchase. They're doing forward funding. So they're in bed with the developer, taking on the development risk to completion, and they're funding the development. So they're taking all the risk of the cost escalations. And your question should be, well, why are they not doing forward purchase? Because they don't know the forward purchase market.
Yeah.
We know how to design rental product. They don't know how to design rental product. We're the largest. We know exactly how to do it. We're developing that. So we go in there and we actually hire our consultants in the UK that we then forward on our design schemes and our specs, and then they ensure that the developer is complying with our design spec. So
And if the
that
developer fails or can't live within the margin of the risk, then you just step in, right?
then we step in. But throughout the piece, we're monitoring.
Yeah.
We've got technicals, we've got due diligence, we've got architects, and we've got property managers. We're ensuring we've got the right rent set and we've got the right technicals that are being deployed. So the developer hires their own, we hire our own as well.
Yeah. Totally makes sense.
Um, so let's just talk. So let's just talk a little bit about the dynamics of the market. This will not be foreign or new to any of your listeners on the call, but you see strong population growth. The latest government that just came in the UK in August, they set a target of we want to deliver 300,000 homes a year. Okay, they're up to half of that. And if you look at the numbers from 23 to 24, they're declined. They've only delivered about 157,000 homes. The previous year, they did 158,000. So basically, shortage of rental product. That's why there's a demand for our product. That's why there's a demand when you build rent. That's why we're seeing the rental growth that we are. Okay. Owning a home, it's actually 75% higher. The cost is higher versus where it was 4 years ago to owning a home today. It's roughly £1,700 a month cost just to own the home, which is your property tax, your maintenance, and your interest on a mortgage to own that home. That's up 75% from 4 years ago.
Wow.
Just imagine that escalation.
Yeah.
And then in terms of renting versus owning a home, it's roughly 35% less expensive to rent versus owning a home. So all that demand has created an 800,000, I said a million, it's 800 to a million unit deficit by 2027.
Yeah.
That's why we're seeing demand for the product. So
Has
our,
the government stepped up, or is it just too squirrely to get them to do any abatements or
it's
anything
too
like that?
soon. That is such a nascent market because there's only 115,000 BTR units in the whole country. They haven't mobilized
Yeah,
around
they
it yet.
haven't figured it out. Yeah.
They haven't figured it out. And what's going to happen is over over the next, call it decade, I would say, this inefficiency that's embedded in the market, the fact that we're able to buy at 170 basis point discount to stabilize cap rates, I will that be there in a decade? I don't think
Probably not.
so.
Yeah.
But let me tell you, our exit in 4 or 5 years, we'll have a lineup of investors that want to get into the BTR market in completed product, fully stabilized.
Totally makes sense.
That's going to be the exit. So all these guys that are coming into BTR now, this 8 billion of equity that came in 2024, you can only imagine who our exit's going to be to.
Yeah. Let's
Okay,
take this one question before we move on to the next subject. And
please.
I'm just going to read it because I'm not sure I quite understand it, but maybe you do. What again is the stabilized yield to cost that you're targeting? I thought I heard a four handle on the cap rate, the cost of debt. You have negative financial leverage on your debt costs, and if there's a principal, there likely is no cash flow. Can you discern my choppiness from that?
Totally.
Okay.
So let me tell you what's happening, it's a very good question. So I'm going to take an asset. Maybe what I'll do is I want to share something if I can.
Yep.
I'm
It
going to
should be
share
able to.
something.
Yeah.
Hopefully your viewers can see this.
Okay, so that's the opening page. You're good.
Okay.
You
So I
can
want
move
to
on
show
to
you
wherever you
something.
want. Yeah.
Okay. Okay. So you see this slide here?
Yep.
These are two assets on the left and the right that we have in our Fund One. The one in the middle, we don't own Central London. I'm showing it to you as a comp.
Got it.
So this particular asset in the London commuter belt, I'm on the one on the left. We bought that at 184 basis point decline. Okay. Now we only put on the leverage. We'll put debt on this while we're going through our lease up as a bridge to a permanent financing at the end. Now, my point is, where we're seeing rates now on the forward curve, because we're going to have to go on a forward curve by the time this gets completed in 3 years, is roughly now, call it, I would say 6%, 6.25%. That may change, right? But right now we're seeing SONIA forward curve plus the spread 6.5%.
Yep.
So right now, when you look at this, you see what the uptick will be, because that cap rate, we're buying it at a 6.4. So I'm already experiencing positive leverage. What you're also not picking up on is this. As we're going through the P's, we're underwriting it at today. But what's going to happen is, as we start going through the P's, I'm going to be, my rent, if you will, continues to grow, because I'm underwriting this at a 4% rental growth, which is my, here you go. If you
Yeah.
look third from the bottom,
Yeah.
my underwritten rent growth is 4%. In the London commuter belt, in this particular market, I'm seeing 10% growth. So just imagine, as my NOI is growing, that yield, I'm growing my effective stabilized yield as well on my cost. So my yield on cost is going to start growing between 75 or 100 basis points a year. So I'm going to grow well past to what my financing will be at the end.
Yeah.
So I expect to be in positive leverage territory. Even though this is core product, I'm getting value add returns on this. Now, what's not included in here are all the amenities that get added on. But there's so much sensitivity in this 19% return that if I, for example, don't experience 4% rent growth, but in fact, because this 19% return is based on 4% rental growth. But if that 4% becomes, 5%, right? You could imagine that 19 can become 19 and a half, 20 very quickly.
Yep.
That
And
rent
what
of
and what's the precursor to 2023? Has it been pretty rental growth 6, 7, 8, 10, 9? Like
yeah, I mean,
is the
look,
graph pretty consistent?
the graph is consistent. I wouldn't say that I would forecast out that market rent growth in perpetuity.
Yeah.
I think there'll be some years where we start to see immigration start to fluctuate. We see natural turnover in some of these assets. So I would say rent growth would be in that, call it 5 to 10% range. When you look at Manchester, though, on the right, Manchester's been experiencing sort of north of 10% rental growth.
Mhm.
So that way, we're underwriting at 4, which gives me an 18 and a half. You could imagine at 12.5%, what it actually is, if I experience that, I'm going to be in the mid 20s very quickly. So I say that because when I go to this, which is my fund one, these are the assets in fund one. I'm tracking to a 24.9% IRR
Nice.
because I'm actually, I'm getting the buildings are getting reappraised, and the appraisers are coming in and saying these aren't 4% rental growth rates. We're seeing higher actual in the market, and we're seeing assets trading at higher values. I
Yeah,
hope I
so
answered that question
yeah, I
for
think
you.
you did. Yeah. And if he didn't, whoever asked it can ask it again in a different way. So it makes me think about this, and I know you can't give legal or accounting advice, but if I'm a US investor, one of the benefits of investing in real estate is it comes along with lots of goodies, cost seg and all that business. Is this, as far as you're concerned, not your concern, and that my accountant needs to address that issue as I deploy capital into this? And are you going to give me a K1 that can that I can dissect to take advantage of those things as a US taxpayer?
Yeah, so I will tell you right now, because we have investors coming in from around the globe, we keep KPMG very busy.
Yeah.
So KPMG are our tax advisors on this.
Yeah.
And right now we are, so the answer is yes. I would say that I know that there are certain laws around and certain tax rules around. Do you come in as an individual? What does that mean? If you come in as a US corp, what does that mean? Do you come in through a US feeder into a Jersey company, or do
Right.
you go directly into a Jersey corp, and those units own units in the fund? So all of that now is being evaluated and being tested. We want to gauge interest out of each of the particular markets. So my answer to your question, because I know your listeners are probably want to know this, I would say that we're working with KPMG to design the most efficient structure for your group of investors that decide to come in.
Yeah.
That's what I would say.
Yeah. Fair enough.
So I would say we're completely aware of it. We're going to design the structure that has the minimal amount of tax leakage possible, which we do for our global investors.
Yeah. So
Yeah.
right now, it's probably too soon to prognosticate about the next step in the UK, but this gets underway. You've already uh, raised half the money. You've got a 10% bump in there, 22 million bucks or whatever the right number is, and you'll raise the rest of it. Is it going to take you another year to go into the next fund? What does that look like in this? And we can talk about Spain too, because that's super interesting. But do you see yourself just doing it again in the UK?
Yeah, I mean, what we're seeing a lot of interest in the UK BTR market, and we want to be opportunistic. So we think we've got the right size. If I showed you on that previous slide, our first fund was 230 million pounds, fully deployed, generating 25% IRRs. We've already brought one asset online. We're starting to lease up. I just topped off Liverpool, beautiful product in Liverpool. We have another one in Ashford coming online. So it's happening. So because of that demand, we said, okay, let's launch a second one. Now this is going to be a little bit bigger, 500 million pounds. We're already halfway there, and we're going with another 1,800 units or 1,900 units. We're going to be opportunistic. The truth is, we're seeing a pipeline. We see about another 3,000 to 4,000 units in a pipeline that's
Wow.
coming our way.
Yeah.
So the answer is yes. But I'll tell you what we found the most interesting is the exit ramp. That we found really interesting because we're having global institutions coming to us asking for the product finished. And it's like, well, because their mandate doesn't allow them to take on the development risk,
Right.
even if it's a forward purchase. So we know to some degree, and I'll never say that there. I won't even put a measure on the certainty or the anything like that, but we know there's a stable of exit ramps, ways to exit the portfolio because of the global institutions that are already looking. But I don't have to tell you that. I don't have to tell you anecdotally. I just look at the equity that's flown in on a forward funding basis,
Yeah.
how much capital they're prepared to put in,
Yeah.
and take on all that risk when I'm delivering a stabilized unit.
Stabilized asset. And but you tend to hold on to stuff though, so this will be a little, right? This will be a
We
little
tend to hold on,
unusual.
except in our commingled strategy. So for your audience, we grew our business basically joint ventures with global pension funds, and those are long term, those are long duration
Yeah.
GPLP structures.
Yeah.
In 2018, we launched our first commingled structure in Canada, which was a repositioning strategy with 5-year terms, 5-year closed-end fund with 2 1-year options. We've grown that to about 6.5 billion of assets. So our last fund in
Wow.
Canada was 1.2 billion, fully deployed, and it's tracking mid-20s IRRs. That's our Canadian. So to your point, yes, we tend to do longer hold, but in these commingled family office, ultra high net worth, multifamily office, we tend to do 5-year structures with 2 1-year extensions. And we only put the extensions in because in certain markets where we're seeing they're not conducive or they're not favorable, we want to have the flexibility to be opportunistic
Yeah,
and,
not have a fire sale, right?
yeah. If I can just, I want to talk about something if I can, and I don't want to
Yep,
jump around. I don't know
you're
if there's
good.
any other, if there's
Whatever
another
you want. Go
question.
ahead. Yeah.
I want to show your listeners something. So you could see this, right?
The
Uh,
opportunity summary of seed.
yeah.
Now,
So
why
these are the
now? Okay.
pipeline.
Yeah.
Okay. I want to talk about two things if I can. If you look at page 20, I talked about the J curve and the cadence of calling capital. So you could see here how you would deploy your equity. Someone that puts in $1 million, We do you typically have a deposit of 7.5 to 10% at signing when we sign up the what we call the heads of terms
Yeah.
on a deal. During construction and all the value add initiatives that's being built, that's all through the on the developer's account. And then at completion, there's a delivery of the remaining equity. So years 0 to 3, you would be about 40%, and years 3 to 4, about 60%. So 40% of your equity is called in years 0 to 3, with the balance in years 3 to 4. So for high net worth and family offices, it's a very good cadence in terms of knowing that you're participating in the upside at minimal equity. You're shoulder to shoulder, you're getting access to institutional quality real estate, but you don't have to come up with the equity until three or 4 years later. Now, I talked about our pipeline. This is what we're seeing now in terms of a deal pipeline. So, Arthur, when you asked me, what do you think's next?
Yes.
We'll close this fund.
Yeah.
We'll close on the 400 or 500 million. We'll deploy it, but we've got a large pipeline in our core markets, which is LCB as London commuter belt, and cities like Birmingham are major regional centers. Okay.
Mm-hmm.
So these are the 3 assets in the seed portfolio already. So for your audience that says, hey, I like what Starlight's doing, I like the UK market, I like the BTR market, these guys know what they're doing, they're institutional, they're best in class, and they've got a seed portfolio, this is the seed portfolio that you would be buying into.
Nice.
So 2 are in Manchester, 1 is in London commuter belt. These are right now modeling out to about a 19% to 20% IRR. But I'm going to show you on the next page, because I'm very transparent. I want to show you how sensitive the returns are to changes in some of the assumptions. But I want to just show you something. What we do differently when you're saying, well, people will get into it, they don't know how to amenitize the way we do. We're partnering with market leading developers. We're getting it at a great basis. I'm going to show you that in a moment. And we're keeping the rents affordable. That's how we're going to keep our buildings full. So let's look at that, okay?
Yeah.
So here's an example. This is our asset. I believe this is our asset in Manchester. This is in Manchester. This is Greengate, okay? We purchased it at 180 million. We're putting in 87 million of equity. We're buying it at a price per foot of 482 pounds. The neighboring comps are 570 pounds. So just imagine the discount to replacement cost that you're coming in at, the defensiveness in your allocation. Okay. We're buying it at a 6.1, roughly a 6.08 cap rate.
Yeah.
The stabilized comps are around a 441. So we're getting it at a 167 discount.
Yeah.
Okay. Our underwriting is 1,830 on average. That's our average rent that we're assuming on our, I think it's a 2-bedroom. Okay. The market is at 1941. In Greengate in Manchester, we underwrote 4% rental growth. The 3-year CAGR rent growth is 10.1.
Yeah.
Okay. Let's look down below on this bridge. This is sort of the money shot here.
Yeah.
If you look at the gross unlevered with leverage, you're at 19%. That's our underwriting at 19% that I told you.
Yeah.
If I grow rent instead of 4% by 4.5%, that's 230 basis points on my IRR.
Where's the delta? I'm sorry. Where's the delta expressed, the difference between the 19 and the 2.3? What growth rate is that?
If my rent growth is 2.3%.
Oh, I'm sorry. Okay. Yeah.
Yeah.
Got it.
If I grow, so instead of 4%, I come in at 6.3.
Yeah. Yeah.
So if my rent growth is 6.3%,
oh no, I'm sorry. You got it down here,
sorry.
50 basis points. So
Yeah,
now
sorry.
you're at 21. Yeah, I got it. Yeah. Okay. Yeah.
If I take my rent growth from 4 to 4.5,
Yeah.
I'm adding 230 basis points on my IRR.
Yeah.
If I take that 1,830 average monthly rent and I add on $50, I'm going to add another 250 basis points of IRR.
Yeah.
So do you see how sensitive it is
Yes.
to small tweaks? Okay. These are some of the buildings. So this is the asset here in Manchester. That's the Trinity asset.
Yeah.
Okay. This is Greengate. and this is the one in Basildon. But look at the amenity packages. Look at the finishes on these.
Yeah. Yeah, you know what you're doing.
Yeah.
Courtyard lounge. What's the exit cap rate? Someone has a question on Greengate.
Well, look, in terms of our underwriting, we typically underwrite anywhere from a 15 to 20 basis point expansion on stabilized.
Yeah.
We don't assume get compression. We don't assume compression, and we don't assume flat.
Yeah.
We assume 15 beeps to 20 beeps expansion over the piece.
Yeah. Fair enough. Yeah.
Okay.
Super cool. Yeah.
Okay. So that's our UK. Let me share this with you. Um, so here's basically the opportunity. We're going to follow the same strategy as our Fund One. Okay. The only difference in Fund Two is that we have a seed portfolio to de-risk, and you've got a really good cadence in that J curve. Okay. Again, we're following in great markets. These are major regional markets and the London commuter belt. You know, the London commuter belt is funny. You're getting 30% rent, less rents in terms of the cost. You're buying at half. You're 35 to 40 minutes away from central London by tube, and there's great rent growth, great employment growth, and great population growth in those markets. It's a no-brainer for us. So we're looking at 400 to 500 million with a hard cap of 600. That's roughly a billion of assets. Sorry, I should have mentioned this, and I'm sad that some of your listeners fell off the call, but we're putting in 25 million pounds.
All right.
So that's something that's very important for everybody on the line, and
Yeah,
I
you
hope I
got
make
skin
that
in the
point.
game to a real number. Yeah.
Yeah, we're not a fee player. We're the last dollar out, and we participate in everything.
Yeah.
So we're shoulder to shoulder with everybody on the line. We're putting in 25 million. We've got the seed portfolio. It's a 5-year hold with 2 1-year extensions. We're targeting 18 to 20% IRR, and our first closing will be in June 30th. So look, it's I wanted to show you one more thing before I say goodbye and before any more questions. This is who we are, Starlight. We're 30 years in business. We have 70,000 units between Canada, US, and UK. We've done 55 billion in transactions. We have 375 people plus our UK. We're 30 billion in AUM. We've got our London office, Toronto, BC, and we're looking at Spain. And this is our business. I talked about our Canadian residential business, 55,000 suites, 11,000 suites in the US, 4,000 suites in the UK, and our commercial business. So,
It's wild.
um,
It's wild how big you guys are.
yeah, yeah. So, look, we're in the relationship business.
Yeah.
We look at these partnerships as relationships, and we've been around for 30 years. And we would love to build more relationships, and hopefully there's an interest from some of your partners on the phone.
Yeah. So, uh, we have a question that we can't answer right now, Joe, but you're welcome to get in touch with Glenn directly, only because it requires a little bit more time than we have. And I appreciate you. It is, you don't have to apologize. So Joe was apologizing for getting in the weeds a little bit, and you don't need to, but you're certainly welcome to connect with Glenn directly, and I'll answer those questions. And we'll send you the copy of the questions, Glenn.
Yeah, we would love to speak to anybody. Go through Arthur. He is my contact. You can reach out to me directly, whatever Arthur decides. But we want to build relationships. And if it's just a function of getting to know us better, we're also no pressure business, right? So, we're not going anywhere. So, if this is something you want to explore, we're delighted. If it's not, that's okay too. We just want to get to know more people out in the market, and tell you about our business.
Yeah, super cool. I'm looking forward to hearing about Spain too at some point. So,
Yeah,
just a quick summary, half of the amount's been raised. It's got a 10% bump built in because of the seed portfolio. The Starlight has $25 million skin in the game. Really
yeah,
important to recognize that. Clearly, you know what you're doing there as well. So, institutional quality investment.
yeah.
So, uh,
I think that's right. One of the things we've been telling we do a lot of business with family offices like everybody on this call. And what we say is that this feeder allows the access to institutional quality real estate, and you're shoulder to shoulder with investors that have put up 40 million, and we're creating this feeder to come in at a much smaller amount. The only other thing I would offer up is if there's groups on the phone that say, hey, I want those economics.
yeah,
That's something we can do too. We can aggregate a bunch, come in, and we can work that out as well. Again, we're the real estate's the real estate. You're going to do well on the real estate. You see what it is. We're happy to fly over to the UK too. If there's anyone on the call from the UK, we're happy to go over there and meet, walk you through the portfolio, and look at some of the sites, look at what the assets that are completed. But really, it's about relationships. You've got to feel comfortable with us, and that's really it. So I can show all the great numbers, but you gotta feel that you're talking to someone with credibility and integrity, and that our company is that. So I invite you to look at some of our partners. We do business with the AIMCos, the PSP, the Blackstones, Future Funds of Australia, a bunch of the Asians, and global pension funds. So we're the real deal, as they say, and we'd love to um, you know have an opportunity to do business with some people on the phone here on this fund.
yeah, I appreciate that, Glenn. And you've been through the proctology, ex
Yeah.
proctologist exam with those
Yes.
folks for sure.
Yes. Oh yeah.
Yeah.
These
Now,
are these are 100-page operational due diligence binders, and
yeah,
we come through with flying colors.
yeah. I super appreciate you doing this again. And for the group, we're I think it's a week and a half from now, we're going to be doing this and digging a little deeper into the details so you can give heads up to others that might be interested, but you'll be receiving an invitation for that. And then we'll share the recording as well as Glenn's information. So again, thanks for everybody for being here. And Glenn, thanks for doing this.
My
Super
pleasure.
good. Yeah,
Yeah.
nicely
Hope to
done.
hear from you guys. Thank you.
And as I always say, thank you for sharing with us the only thing you can't make more of, and that's your time. Thanks, man. Really
Thank
appreciate
you.
it. Okay, take
All the
care.
best, everyone.
Bye-bye.